Next up, we do have Ben Fitchu from Ardevra Asset Management in the UK, who's a portfolio manager on our Global Behavioural Fund. And fingers crossed, I have Ben on the line as we speak. Ben, can you hear me okay?
I can indeed. Hello.
Fantastic. I can see you now. Ben, the audience, I guess, have become quite accustomed to seeing Jeremy Lang on the other side of their screens, and this is the first time you are a debutant on our Fund Manager workshop. So thank you so much for joining us today. It's always nice to get a fresh face and a nice insight into the personalities behind the fund.
Cool. Thank you for having me. Yes.
And then before I get into my first question to you, Ben, just a kind of a recap on the Ardevra strategy. So they really do a study of behavioral science, try understand some of the destructive behavior that CEOs can undertake, but then also how that is interpreted by buy-side investors as well as sell-side analysts and the type of mistakes they may make during this process. And the Ardevra philosophy really looks to identify those mistakes and I guess capitalize on them as well. So what you do end up with is with a portfolio that has a tilt between both value and growth, and this is largely informed by what's happening and what's developing, at least on the macro front. And I guess I'd like to bring in Ben over here, as well as I'm going to provide a little visual to Ben's answer. Is Ben, how has the fund done? Because I guess for the last sort of 5-6 years leading into COVID, the tilt in the fund was largely towards a growth style stock, as we see on the slide here. I don't know if you can see it on your side, but then I guess since the onset of COVID and what's happened in Russia, the tilt has gone a little bit more to the value side. So maybe if you can talk to us a little bit behind how that information has taken shape and the fund has developed through that period.
Yeah, so if I give a bit of context and history, as you can see from the start of the fund, the first few years we had more of a value tilt, and then from about the end of 2014 onwards till basically the onset of COVID, in the middle of COVID in 2020, we've had a growth tilt. And the tilts that we get tend to be driven by bottom up, where we find interesting management behaviour. As you said, we're interested in the behaviour of CEOs in particular. We think they form a lot of interesting risk, if you like, that comes out in the stock market. And for the majority of the last few years since 2015 onwards, management behaviour in growthy businesses has tended to lead to more surprise and more reward in share prices. And we found that bottom up. Now, we know that also in particular in COVID times, the onset of COVID, particular types of businesses were able to withstand the pandemic very well. And obviously they were slightly more digital focused than other kinds of businesses, either in software or in e-commerce or in streaming type businesses. And generally speaking, those ones were well rewarded in a recession that nobody had expected to come along. And so we found those and did reasonably well in that period from 15 to through 2020. But from then on, we've started to find more interesting pockets of value as the recovery from COVID has started to sort of roll out and as it's evolved. And you can see that from in the middle of 2020, the green line, we picked up recovery stocks in a variety of areas through 2020 to 2021. And then in the back end of 2021, we thought that we could see emergent signs that some areas of recovery, particularly in sort of businesses in the middle of supply chains, were struggling for all the reasons that we have all heard about supply chains struggling, inflation, wage costs going through the roof. Basically, we felt that there was an emergent set of evidence that that some of the growthy names that we've been watching for a while in software and in healthcare were in a good place. They were surprising. Management behaviour looked very good, and we bought into those in November. And since then, we've had to flip. We've struggled. Growth names have sold off aggressively with inflation expectations being beaten and the Fed changing its views, and that's led to a lack of reward in growth stocks, in particular high-flying growth stocks. So that has led to us changing our views. We've gone back to our screens, looked bottom up once again. We've seen in the growth stocks a lack of reward, despite very high levels of surprise, which is the thing that we really care about, and we have a good track record on finding stocks that can beat expectations. But because of the way investors are behaving right now, growth stocks in particular are suffering from basically the worries about bond yields, and that's impacting rewards. So surprise is not driving share prices up. in growth stocks, whilst big surprises are being particularly well rewarded in certain areas of value. And we've started to pick up, again, bottom up from our screens, finding interesting areas of value names, and that has led to the fund tilting quite strongly back towards value. And the areas of value where we're seeing interesting names come in kind of two flavors. Either areas where you're getting big surprises, which generally speaking can be unpredictable, but they are backed up by a very strong management behavior on the supply side, so in certain areas of commodities, so copper miners, aluminium, steel, fertilizers, and some of the sort of bits of kit that feed into those areas. And so those are cheap names where they're seeing big surprises and big reward. And then in slightly different flavor of value, which are the kind of predictable laggards. So quite a lot of predictable businesses lagged through COVID because either they weren't growthy enough or they weren't recovery names. But now they've got an interesting setup of 2 or 3 years of anxiety now and skepticism around share prices. And we've started to pick up some interesting names in some of the admin names, some businesses in defense, which are actually surprisingly predictable businesses. And generally speaking, starting to look at some what we call slow to grade, sort of very solid businesses that have lagged, like SAP, the German software name, and Roche, which is an interesting sort of unusual pharmaceutical name. So 2 different flavors of stocks where there's anxiety around it, with quite different drivers. The supply side is very strong. Obviously, lots of supply constraint in miners and various bits of commodity complex. And then in these predictable names that have lagged. And that has really led to the tilts that you've seen there. And to your question about, how have we performed, we've struggled over the last quarter. Now, a lot of that was the impact of the growth names that I mentioned that we bought in November, which were in healthcare and tech that were sold off. And we've sold out of those. And so we've reacted to a lack of reward. We care about whether or not share prices are responding to good news. Now, for most of the last, since 2015, growthy businesses that put out good news were well rewarded with good share prices. That's flipped for the moment. So it's an really interesting period where share prices aren't responding in quite the same way they were in the pre-COVID era.
Thanks so much, Ben. And I guess as the old adage goes, it's not necessarily the fittest, the strongest, and the brightest that survive, but those are able to adapt. And if we've got time at the end, I might want to address that adaptation concept again towards the end. You did mention a couple of the sectors in terms of their performance. And before I start, I want to bring up a slide a little bit later on and maybe a following question in terms of where a lot of that contribution has come from a stock-specific point of view. But for those that are invested in the fund, we obviously get your monthly fund notes that our clients here in South Africa receive as well, and in the UK, and a lot of commentary around anxiety, which I always quite enjoy, the way you guys look at reading anxiety in the market. And the presentation, or the title for your presentation today, is dealing with new sources of anxiety. So within the behavioral framework at Ordevra, how have you interpreted, first COVID, then obviously inflation, and then Russia's invasion of Ukraine through an anxiety lens as well?
Well, I think the interesting thing about anxiety is it comes around stressful events. And I suppose we've, as an investor that there's always stressful things coming along, bad news or sort of something emerges that is difficult to predict. And we're interested in bias. So how do people respond to something new? And when something new and difficult and risky emerges, it often brings about very high levels of anxiety. And that leads people to try to do a number of things. Firstly, they get very anxious, and that can lead to overreaction, so selling too much, too aggressively. But also it then leads to a sort of analytical desire to find a good reference point. And that's that kind of anchoring phenomenon. We always want to find something where we can explain the current thing that we've got. And with COVID, obviously the fascinating but difficult thing about it was there really weren't very many good reference points. You could go back to the flu of 1918, but the world economy was drastically different. You could go back to the Black Death in Europe, but it barely had an economy. But one of the interesting things about both of those periods that you can get out of it was that they led to certain forms of inflation, reshuffling of the way the workforce works. And so that was one big takeaway, is that it can lead to a kind of reshuffling of the way everything works. So we saw some interesting effects there in COVID, in that everyone could sort of try and guess where the reshuffling will go, but it's very unpredictable. So you look at, say, the path of Zoom or the path of Netflix. The first phase is we all buy into the idea that we're all on Zoom and that it will dominate, that we're going to be streaming. More people will be, easy to get in new customers until we have a really benign period of growth. But it's quite unpredictable how you exit and go back to normality. And so we've seen that with the share prices of ARK very high, and then, as with Netflix falling over 30% yesterday, it's possible for a really quite a big shift in how people perceive risk, both on the upside and then on the downside. So first step is it's quite unpredictable. The way COVID seems to have behaved is more like a natural disaster than a classic recession. And it's thrown up lots of interesting things to do with the way that the structure of the economy. So it created many more small businesses than any other recession. Usually recessions destroy small businesses. So there's been a reshuffling, and the predictability of revenue is still low. It's quite an unpredictable environment. That's what the first point we would say. And then obviously with the Russian invasion, we've now seen another highly unpredictable event. Quite a lot of commentators were not expecting this to happen. So I think one of the points that one of your previous speakers have been making is that wars tend to last longer than you expect, particularly between large countries. I know this is not, obviously one country didn't want it, but, this is, they tend to be last longer and have more extent of impact than people expect. And then that goes into inflation. And so what we're really seeing is that the stock market didn't expect inflation, and it didn't expect the Fed to behave the way that it did. And that has impacted bond yields, and that impacts the reward of certain types of stocks. So if we take a step back, you had two anxiety-inducing events. They're both quite unpredictable. They will have long duration, but we're still in this phase where it is quite unpredictable. No company necessarily knows what its true revenue is. Supply chains haven't truly sorted themselves out. There's lots of narratives. There's a narrative explanation of reshoring, but it's still, if you pick through the evidence, it's still slow. There's, it may be that China's share of, making things has dropped slightly, but Vietnam's has gone up. So one has to be careful of jumping the gun on certain themes that have plausibility, if you like. So I would say the way we deal with new sources of anxiety in particular is we try and find reference points that give us an outside view, because that helps with bias, or acknowledge when it's highly unpredictable. And we think it's an unpredictable environment, is one point. And then the second one is that it's amplifying some interesting effects on management behavior, because we look bottom up. And you can particularly see that in the commodity complex, where you see multiple cycles of behavior now layering up. We know that the miners and steel and fertilizers have gone through sort of boom-bust cycle and been in recession, and now they hit COVID, and then they've hit the supply constraints from Russia. You've got layers of management behavior and supply constraints, and that could last longer than people expect. And I think that's the interesting thing here, is that there's a reason to own certain types of value names that aren't just cyclical recovery. There's structural behavior that's amplified by COVID and then war and the prior boom bust in mining and various commodities. So I suppose my main point is there's a lot of anxiety, but there's also this interesting reshuffling, and we look.
Okay, I think we may have lost Ben there. But what we did see there was that tilt, as Ben mentioned, from kind of that growth into some of the value stocks. We got Ben back, have we, Ben? In the interest of time, I'm going to shift on just to check you can still hear me okay. I think you can.
I can. I'm sorry, I talked for about 10 minutes, but I didn't know if you caught it.
No, we literally lost you, I think, for the last 40 seconds. At least that's what my sweating is telling me. I've been sweating for 40 seconds. So what I've done now...
Tell me about management behaviour and the structural sort of effects of what's going on right now.
Yeah, exactly. So what I've done is I've actually moved to the next slide now that looks at where your major contributors are happening in terms of the last quarter. A lot of household names there, some less. So I don't know if there's any you can talk to. I think what I always find quite stunning when I chat, obviously have the luxury of chatting to you fairly regularly, is for the audience out there, the fund can hold anything between 150 and 250 stocks, and that was shown in the last slide as well. So whenever I pick Ben's brain, I'm always quite amazed that you can talk to any of 150 stocks, Ben. So I don't know if there's anything you want to pick from that list there and maybe just give us a sense of where some of that performance might have come from and then your thinking behind it as well.
Yeah, I think, not to pick out one that's done the best out of it, but it illustrates the point. And Mosaic, which is, a fertilizer company, obviously potash and fertilizer was a really growthy industry when in 2007 and 8, and people were very excited about it. And they went through, the industry went through a sort of 10-year recession. And that has slowly led to what we call a kind of capital cycle. So management behavior has been beaten down by repeated failings of too much supply. And the industry is finally in a state where, supply is much more constrained and the lead time on new supplies is much further out. And they're basically in a constrained supply, strong demand environment. And that is just a very good setup for value. That can lead to surprising amount, length of surprise and unwind of anxiety, and that industry has been unloved for really quite a long time, and that's that layered management behaviour that I hope you caught me talking about, or maybe I was just frozen for a while. But hopefully you saw that they had this excess ramp up of supply from the GFC, and then. There's a long period of disappointment, and that drives this feedback loop between share prices and management behavior. And in fertilizers, that's particularly interesting right now. But it's also true of aluminium and steel and the miners in certain key commodities. And it's being amplified by what's going on with Russia, which obviously Russia and Ukraine are kind of key suppliers of some of the inputs and in particular to fertilizer. So that's where that sort of that area has really found an uplift because of the war. But it's set against bottom up management behaviour that really fits. So that's one of the particularly interesting ones. If you just look at the set there, a bunch of them fit that. There's a couple of banks, Capital, which obviously you'll know, Alcoa is an aluminium name. Again, aluminium has been a really difficult industry to be in. Steel, again, as a fund manager over the last 15 years, since the GFC, it was really sensible to not touch a steel company. They've gone through a long period of restructuring and capital exit. Again, the influence of China there of exiting some of the sort of dirtier and higher cost end of things has benefited. Rio Tinto, again, copper and iron ore. One element is obviously one quantity is critical to decarbonisation, the other to development generally. Again, management behaviour is really good setup in that industry. Coles is a department store, very, very different. Again, retailers had to change a lot in the last couple of years. So as you can see, those are all value names, and a lot of the behaviour of a lot of the contributions come from value stocks. And particularly the flavour of the market we have is that you're seeing share prices where there's big supplies is getting big rewards and stocks that have been cheap and unloved for a while.
And then maybe Ben, time has absolutely flown by. Probably a last kind of question and more an observation for today. So you equally weight each stock, I guess, to remove your own bias as well. So when you got something like Capitec there at 1.2%, is that a factor of the share price really doing well throughout the quarter? Another one maybe with observation here is Meta Platform, which I guess is Facebook. I think you have historically held this, has obviously sold it down. And given what the stock has done negatively, that's obviously been a positive contributor. And then a very loaded question, but it required quite a quick answer, I guess. And then someone like BHP, when I try to think about your management behavior and skepticism from shareholders, given some of the natural disasters in South America, they had that incident in Australia as well. Has this led to more prudent management language and behavior as well?
Yeah, I think also, these areas are tricky, aren't they, from the behaviour on the E part of ESG, I guess. But what we know is that these are very necessary commodities in development and for decarbonisation. So it's important that these businesses do what they do. But it is important that they react to some of the things that go wrong in the way that they do their business. And so I think what we're seeing in the mining industry is there is change there. And that doesn't mean you can't own them. Yes, they have risks in some of the things they do, but I do think what you can see is that particularly engagement strategies and some of the missteps of recent times is you're starting to see proper change in those industries. But I take your point. But I think it's a grey area with these companies, and I think we're starting to see change.
Excellent. Thank you so much again, Ben, for your time this morning. Do send our regards to Jeremy and the team there, and we'll be catching up with you maybe in person in our London Summit in June this year. So take care.
I think that's right. Yeah, I look forward to seeing you.
Okay, wonderful. Cheers, Ben.
Thank you.